What's up, guys? It's Riley back with another market update. Today is Tuesday, June 28th, 2022. Before we get into inventory, if you like this video, if you find it informational, go ahead and subscribe, like this video. It really helps out the channel a ton. Let's get right into inventory. As of right now, our inventory is sitting at 13,766 listings, up from 12,542 active listings as of last week. That's a 9.6% increase. Again, another increase, not very surprising here, but actually it is less of an increase than it was last week. And what could that mean? It could mean that we have peaked in the amount of houses every week that we're seeing come to market, and so we could see a slowdown and more of a stabilization of the market rather than just such of a sharp increase that we have seen over the past 3 months. An interesting fact about that 13,766 active listings that we have on the market as of right now, 50.3% of those are vacant. What does that mean? Well, it means that it's not just like I'm selling my house and I'm living in it. It could be an investor, it could be an iBuyer, it could be someone that sold that's going to rent. That's going to be a lesser number. But could this be a wave of investors that are going to the market to basically get their house on the market so that they can get out while the market's still hot? It could be, right? We're seeing over half of the listings on the market be vacant. So a lot of those could be investor owned. Maybe the smaller institutions own these houses and they're going to market to get the best price rather than packaging them together and selling them to a larger institution. But people are rushing to the market to get these houses sold quickly while the market's still hot, while we are still in a seller's market, rather than when it gets to more of a stabilization and equilibrium and maybe into a buyer's market. We'll see. It really depends on the Fed and raising the interest rates, along with a lot of other factors, of course. But this is why real estate is a very unique asset, because in terms of stocks, say everyone thinks the market's really high in stocks and they want to sell out. You don't need another stock to live in and to rest your head at night, right? In real estate, you have a house, and this is my primary residence right here. I'm not going to sell this house and then have nowhere to live. I don't want to rent. Rent prices are high. I'm locked in at a low interest rate. I'm locked in at a great monthly payment, and so I'm not going to go sell my house because I think the market's high. I'm going to live in it. Everyone that owns a house is not basically rushing to market to go ahead and sell their house. A lot of these are the investor types, which is, that's what's happening. They're coming in, they want to sell at a good price. They'll still get a good price for their house. I'm sure they made, 30% last year, maybe 20% the year before, depending on how long they've owned this house. But people like you and me who just own a house and just one house, we're not going to go to the market and sell our houses and not have a house anymore, right? Especially if we have a low interest rate, a low monthly payment. I don't want to go rent and just have equity sitting, and while inflation's high, and have all that equity get burnt up by inflation. I'm going to park it in this asset. I'm going to keep it in this asset, and I'm not going to go out and sell this house. And that's why this asset class is so different and hard to guess what's going to happen, is because it does act very differently than a different asset class like stocks, bonds, cash, stuff like that. The Fed is likely going to continue raising rates, right? Because we're seeing inflation still at a high number. We'll go ahead and find out next month, here in about 2.5 weeks or so. On July 15th, when the next CPI comes out, we'll go ahead and see when or how much inflation we are at that period of time. I think it's going to be lower just practically. I'm seeing gas prices come down. I'm seeing more rentals on the market, therefore less rental price increases. But we will see what the Fed continues to do. I'm guessing, they will continue to raise the interest rates just because we're seeing a disinflation from where we were. A lowering in inflation doesn't mean, that's the finish line. The Fed wants to get down to 2%. We were at like 8.6 or 8.8%, which is crazy. So we still have quite a ways to go. So they're going to continue to raise interest rates, but hopefully we will start to see a disinflation, not a deflation. Deflation means we are under 0%. We're still very inflated, but we'll see a disinflation, meaning coming down from like an 8.8 to hopefully like an 8 or high 7, something like that. An interesting article that I came across was this, and it was the Big Short. That's Michael Burry, the guy that predicted the 2007-2008 housing market crash, is predicting this next, and you won't believe it. Michael Burry is seeing a lot of these big corporations such as like Walmart, Target, corporations with a lot of inventory going in and out. They're starting to stockpile inventory almost to the point of where you'll go and do a return and they don't want the cost of maintaining that inventory anymore. Some of these corporations are telling you to keep your item that you've returned. It's crazy. But he's seeing that these corporations are stockpiling inventory like crazy, that there could be a consumer recession later on this year, meaning consumers no longer are wanting to purchase as much, meaning these companies are going to have these huge inventories that they can't get rid of. And he thinks that the Fed will reverse their stance. Hopefully by this time, inflation is taken care of, but he thinks that the Fed may reverse their stance and start lowering interest rates again to motivate the public to start spending their money again. A very interesting take. You never know what's going to happen. The market's crazy. We live in a crazy time, but that's what Michael Burry is predicting. If interest rates start to lower again, that will motivate people to start buying assets again, including houses. So we could see a very stagnant market from here to then, meaning the market doesn't really go up or down. It just kind of continues on. We could see a slight dip because interest rates are rising at the rate they are, or we could see, the market stagnate and then that come into play. The Fed lowering rates again, mortgages become more affordable, people want to buy again, and house prices could start going up again. We will see what happens. Getting into the CMI, the Cromford report, we are seeing a 190.9 as the CMI this week as of yesterday. What does that mean? It means 1.909 buyers for every listing out there. So we're still in a seller's market by a bit. We still almost have, for every listing, we almost have 2 buyers for every listing. But an interesting thing that you can see, we're in the red when it comes to demand, 89.5. 90 to 105 is a neutral. Anything above 105 is more of a seller's market, but we're seeing a red demand. We're seeing not neutral, below neutral demand because of all these interest rates, but we're still in a seller's market. Why? Well, it's because supply is at 46.9. Again, there's not a lot on that market, even though we've seen this sharp increase in supply, we still aren't at the equilibrium point. We still have quite a ways to go to get there. And so I'm guessing, the market will continue to stabilize. But this is why some people are saying the market's not going to crash, because we still have a lot of houses that we need on the market to get to an equilibrium. We'll see. That's up from last week, though. We were at 210.2 as the CMI, where the demand was at 91.9, so it was neutral last week, and then supply was 43.4. So we're seeing those numbers move, but not as drastically as they were before. So practically with my own clients, I'm still seeing houses go over and above ask. Even a house that we put an offer in last week was listed at $599, and it went pending at $635, $36,000 over asking price. And that is, again, kind of nuts, but if you price your home right, you will be able to do this. That house had the right comps to support it. It was, fairly updated, had a newer kitchen, some great backyard features, but it wasn't like the craziest house in the world. It was listed at $599. I wasn't sure exactly about how many offers they got, but it went for $635 as pending. So it's kind of crazy. We're still seeing these houses go over and above ask. Just being able to price it right really puts you in the right market. We're seeing a lot of houses come down in price, in list price specifically, because a lot of sellers are wanting what they saw happen over the past 6 to 12 months, and prices go crazy. They want to take part of that, but if you list too strong and there aren't as many buyers out there, you're gonna have to come down in your price. Thank you so much for watching this market update for Tuesday, June 28th, 2022. We very much appreciate it. If you like this video, if you find it informational, go ahead and subscribe. Go ahead and like this video, and go ahead and put some comments down in the comment section down below. Do you have any questions about the Phoenix real estate market at all? More than happy to answer those. But my name is Riley with Team CR Realty, where Arizona real estate is seen.